We have a really great first panel this morning to talk about space, whether place matters and how place matters related to financial services. So I'm glad to welcome that panel up this morning. First, Justin King is our moderator, who is the Policy Director of Asset Building at New America and has done policy-related work for a really long time and can help us think about how this research and the practice related to it intersects with the policies that we think about and develop. Jacob Farber, who's an assistant professor at NYU in New York and studies spatial inequality, which is so extremely relevant to the concept of place. Mathieu Despard, who has been my wonderful partner in this project and can talk about the work that he's led related to financial services in metropolitan statistical areas, and the work that he's done there. Lindsay Daniels, who is the Associate Director of Economic Policy at National Council of La Raza and has done important policy related to the Latino community around economic development and asset building. Andrea Luquetta from the California Reinvestment Coalition, where she's the deputy director. Andrea has done one of many things. One of the things that I have found really interesting has been mystery shopper studies that she and her colleagues have done in financial services and to understand the consumer experience with regard to overdraft. And Jeremy Hegle, who is the Senior Community Development Officer at the Federal Reserve here in Kansas City, who thinks about how we have regulation that can help locate financial services and improve the financial health of communities. So please join us. And so one of the things as they're taking their seats that we've also done, we've asked you to fill out these polls, these surveys, to give you a snapshot of what people in the audience are thinking about related to financial services and how that depends on where you live. So you can see the bars kind of there on the screen. The first one, green, so about 6% of you think most people can get a bank or credit union in their community. It's fairly accessible. Mobile, the greenish teal colored bar, mobile and online financial services are a good alternative if there's not a bank nearby. 75%. So those of you who responded here get the A for the day. Right? They're not easy to get to for everyone. And I say that in jest, but that's part of the debate I think that we want to have is, for the variety of ways that people can access financial services, place and mobile technology. How do these things work together or converge or complement one another to help families and households access financial services? And then it depends on a lot of things. So about 11% of you in the room kind of fall into that category. So just as a snapshot to think about, where we as a group are understanding these types of questions as you are getting started. So with that, I will turn it over to Justin and let him talk us through some of these ideas further.
Good morning, everybody. I'm Justin King. It is a pleasure to be here. This is my first time in Kansas City, so I'm really pleased to be visiting your community and having a chance to connect with folks here. And thank you to Terry and Matt and MetLife and everybody who's made this project possible. It is it's really an impressive piece of work, and it's I think the scope of it, I don't think you've really seen yet. I think you're going to get a bigger taste of that. But I also think, as impressive as it is, it's also just scratching the surface of sort of where this work can go. And so I'm really excited about sort of where we are with it and what's happening going forward. I work at a think tank in Washington, D.C. called New America, and I've spent most of the last 10 years trying to change the public policy landscape to make access to financial services access to savings, and the opportunities that having some financial resources can deliver for families easier to connect with for folks who are who don't have a lot of resources, who have low incomes and modest incomes. It's great to be here today. I'm so glad to see that 75% of folks sort of said yes, that place matters, because I think there's going to be a lot of agreement on the panel on that. But I wanted to start, Matt, with giving you an opportunity to sort of walk us through some of what people think there, or the majority of people think is true, and how that shows up in the project. Can you tell us a little bit about sort of how place matters, or how place appears to matter in the Mapping Financial Opportunities project?
Sure, Justin. Good morning, everybody, again. So just as a little bit of background, the data that Terry and I have collected is the full population of bank branches and credit union branches in the entire country, as well as business listings for alternative financial service providers, inclusive of payday lenders, check cashers, pawn shops, and so forth. So as I provide a little bit of overview of these data, please bear that in mind. The key thing that we wanted to answer is what, if any, geographic variation is there in where these services are located. And to help us answer that question, we turn to a density measure, because a common response might be, okay, it doesn't tell us very much to focus just on location if we don't know what the availability of financial services is relative to population. And so we use an important density measure, as you can see behind me, and I'm going to stand up so I can remember what, oh great, and I've got a little laser pointer, excellent. And my intent is just to very briefly give you just some top line findings, some things to chew on, and then quickly turn it over to the rest of the panel, who, in my opinion, will do a far better job of explaining what's happening with these numbers than I could possibly do. So I'm just the numbers guy. Okay, so first of all, just to direct your attention to what some of these numbers mean, pay close attention to the size of the blue bar with the size of the gray bar. And what these two bars are, the blue bar is the density of banks and credit unions per 1,000 population, and the gray bar is the density of alternative financial service providers. So the reason why this is important is to look at the relative mix of banks and AFS providers, because what's true, and you can see this just going down the street, is it's not like all of the check cashers are on one side of town and all of the banks are on the other side of town. It's more of a mix, and it's important to look at what the relative mix is in any community. And what we see is that in the Northeast of the country and in the Midwest, there is a greater proportion of banks relative to alternative financial service providers. So banks outnumber alternative financial service providers to a much greater degree in the Northeast and in the Midwest compared to the South in the West. Why is this important? Because population is growing at the fastest rates in the South and in the West, in the Sun Belt states. So population is moving away from the parts of the country where there's actually a healthier balance of banks relative to alternative financial service providers. And we see that really bears out well in this slide, where we look at the ratio of banks and credit unions to alternative financial service providers. So the way to interpret these data, if you look at the very top, Pittsburgh, which is a really interesting outlier. Anybody from Pittsburgh? So, okay, Terry. Yeah, so, what the heck is going on in Pittsburgh? I mean, it's probably a good thing where banks and credit unions outnumber alternative financial service providers by 13 to 1. And then the red dotted line is the median. And so anything above that red line or to the right of that red line, if you will, is where the ratio of banks to alternative financial service providers is better than usual. And anything below that dotted red line means just the opposite. Does anybody see a distinct pattern here regionally if you look at the list of cities below and above or to the left and to the right of the red line? South and west, exactly, yeah. So again, the Sun Belt cities, metropolitan areas are to the left or below the usual ratio. And this is also true for smaller areas. So it's important not just to look at our largest cities in the US, but let's look at small to medium metropolitan areas as well. And this is the lowest quartile concerning this ratio. And if you notice, this is where banks just barely outnumber alternative financial service providers. And again, as you can see, these are mostly western and southern metropolitan areas. So this is a screenshot of the interactive map that's available now, live as of yesterday on the New America website. And if you look from a distance, and the really neat thing, I've had a lot of fun with this map, I hope you will as well. You can zoom in and out, so if you want to just kind of get a sense of the relationship between banks and alternative financial service providers for a county or for an entire region, or to really zoom in on a particular part of your city or town, you can do that with this map. And I think it provides probably simply some validation for what most of you already know about your communities. And so what we hope is that this tool will help you as advocates better make the case and better understand what's happening in your community. So these first two slides, I just want to contrast two different parts of the country that have a lot of rural areas. So for the moment, ignore Topeka and Kansas City and St. Louis, and just look out at the more rural parts of this region of Nebraska and Iowa and Kansas. And you notice in those rural areas, there's quite a number of green dots, and the green dots are banks. The red dots are alternative financial service providers. But if you look at the next slide, and if you look at the southeast, there's way more red dots, alternative financial service providers scattered throughout these rural areas. So again, for the moment, kind of ignoring Atlanta and other major metro areas, if you look at the more rural stretches of the southeast, there's far more alternative financial service providers relative to banks, whereas again, here in the Midwest and in the Plain States, there's a much healthier balance of banks in rural areas. So this is Kansas City, and so this is an example of where you can zoom in. And one of the things you can do with this map is zoom in and also apply what's called a base layer, which means that you can look at the variation in where banks and AFS are located based on the distribution of income in your community, and also based on the proportion of households that are racial and ethnic minorities. And in this particular case, the base layer is median household income. So as soon as I pulled up this slide or looked at this part of the map, I saw a nice cluster of banks that far outnumber AFS providers to the southwest. And I thought, oh, okay, wealthier suburbs of Kansas City. Those of you from Kansas City, is that the case? Okay, I see lots of nods. Okay. So again, this is an example of, this doesn't necessarily tell us anything new. It just gives us a nice visual representation that maybe we can use in our advocacy efforts. Los Angeles, and Andrea and I had a nice discussion about this, and I'm hoping we'll get into this further on the panel. From afar, Los Angeles looks like just one big blob of payday lenders and check cashers. And in California, in Alabama in particular, two states where banks just, by a slim margin outnumber AFS providers. So there's a lot of alternative financial service provision in those two states. But if we zoom in on Los Angeles, because this doesn't really tell us the full picture, we have to zoom in and look at different parts of the city. And so if you look at the area, the neighborhoods just south of downtown, so this is Inglewood over there in the corner, the left corner, which is going out toward the airport, Florence, Huntington Park, and this is a predominantly African-American part, but increasingly Latino part of Los Angeles. But then if you go west of downtown, going out toward UCLA and Beverly Hills, again, not too surprisingly, where there's higher income and a greater proportion of white residents, there's a far greater proportion of banks relative to alternative financial service providers. And this is another representation, so we're going to zoom back out a little bit in LA, and we're going to look at race and ethnicity, and this is the percentage of households that are African American and Latino. And as you can see in those densely minority populations, zip codes, there is a far greater proportion of alternative financial service providers relative to banks. And then if you get kind of on the western fringe and out toward the coast, where you have less minority households, you have a greater proportion of banks relative to AFS providers. So again, the key thing to understand here is that it's not like you have zip codes with all check cashers and zip codes with all banks. It's a mix, and there's a lot of boundaries that kind of overlap. So it's important just to look at what's the relative mix in a particular area, and how does that relative mix relate to other community characteristics such as race and income. And then lastly, this is from my new home state of Michigan. This is Detroit. For those, anybody from Detroit? Okay, great. So one of the things we know about Detroit is there's been massive depopulation, deindustrialization, and increasingly concentrated poverty in the city of Detroit itself, which is majority, 80% majority African American. And you can see that in the city proper, which I don't have the boundaries, but basically where you see a much greater concentration of red dots is the city proper. And then the band here of a greater concentration of green dots are the wealthier majority white suburbs of Detroit. So this has implications for Detroit in terms of its revitalization strategy and its economic development strategy to kind of stage its comeback and working its way out of municipal bankruptcy. But this pattern in Detroit is probably the same in St. Louis. It's probably the same in Washington, D.C. and countless other cities. So this is probably not unique to Detroit. And by the way, whenever you look at a city, you'll also very, very quickly find its downtown. So the downtown is always where there's a nice glob of green. But then it doesn't take long to get out to neighborhoods for there to be vast stretches where there's no financial services. And Detroit's dealing with a lot of land vacancy. And then, of course, concentrations where there are people living more densely of alternative financial service providers. Okay, I think I'll stop there.
That's great, Matt. Thank you so much. I do want to keep you on the hook a little bit because I want to ask you the burning question for a lot of people. And I didn't mention earlier, but we have some time with this panel, so we're going to chat for a little bit, and then we really do want to engage in a conversation with you. So I think if folks have questions or burning thoughts that are percolating, hang on to them. We really are going to want to engage in a dialogue with you in a little bit here. So my prior assumptions on this are that It's not just that there is inequality in the type of financial services that are offered based upon where people live and based upon the characteristics of those places, but my prior assumptions tell me that matters for the financial lives of those people, right? That there are pros and cons to different kinds of financial services, and if you're in a place that has options skewed in one direction or not, that's going to have impacts on people in those communities. And that's the connection that you guys have worked to make in your research. Can you just, I think quickly, because we want other folks to weigh in, but tell us a little bit about sort of what some of the differences are you see because folks live in places with different densities and different compositions of what we would call mainstream and alternative financial service provision.
Yeah, Justin brings up a great point, because the counterfactual, the point at which you say, but Matt, what about, and the ... would be, does a presence of a bank necessarily mean, or a higher proportion of banks relative to AFS providers necessarily mean anything good for people and households in their financial well-being? And the answer is not necessarily, and stay tuned, because Terry's going to drill down a bit more later, and others, when we examine what does this mean for household financial well-being, and more importantly, what types of bank products and services are important for promoting household financial security. And I think as we all know, if you live in a place which is dense with banks, but all the residents are getting zapped right and left with overdraft, does that necessarily make it a financially more resilient place to be? Probably not. So the short answer is products matter. Products are very, very important. So keep that, take these data with a grain of salt, in that this is just the first iteration, the first look at these relationships. Is let's just start by looking at what the location variation is.
Jacob, I've seen you nodding a little bit here, and your work really has been based on racial differences in provision of financial services. Can you give us a quick reaction to what Matt's talked about and how your work has connected to this, to the mapping project?
Sure. So I'll resist the temptation to talk a ton about my own work, but I would like to connect this question to the poll results, and I'm thankful for everyone who filled out that poll. I think it helps kind of set the conversation. I found myself clicking kind of immediately with the 74-75% saying yes. It's obvious to me that these things matter. I think if place didn't matter, we wouldn't see the kind of variation that Matt has shown us over the past few slides. And in particular, he didn't talk about this, but in the pretty stark differences across metropolitan areas, there were asterisks next to some of those metropolitan areas, and the asterisks indicated that payday lending was illegal in that state. And I think all but one of those MSAs that were in states where it was illegal were above the median in terms of that ratio. So that's one kind of obvious way in which where we live influences the services that are available to us. But one of the things that I think is particularly interesting, and assuming that Terry's going to talk about this a little bit more later, but one of the findings to me that was very interesting from the work that they've done is that there's not only is there variation across place in the service mix, but there may also be important variation across the income distribution of individuals in how the mix of services affects financial lives. So I believe that you found that low-income households, for example, are more sensitive to the local mix of financial services in and around where they live, which to me kind of links to the 11% of respondents to the survey who said it depends. And I, just for one, want to hear from some of that 11% in the Q&A what their "it depends" means, because I I agree with that as well. So while my immediate reaction was, yes, place matters, I think there's a kind of interaction between the environment you're in and the resources that you have as an individual. So, we might, if we step back and think about it, if you have enough money for a bank account, where the bank is might not matter so much for you. If you have that much money, you might have the time and space to kind of shop around for the optimal amount of services and fees that work for you. But if you don't have enough money for a bank account, perhaps you're making financial decisions under duress, and the most immediate, both kind of spatially, but also in terms of who's open at 8 p.m. or 9 p.m. or midnight, that is going to be more relevant to the decisions you make and the type of services you provide or use.
Lindsay, you work for the National Council of La Raza. You work with communities that are heavily Latino. One of the things that Matt pointed out a little bit that pops up in the map is in the South and West, with higher levels of immigrant populations in the Sun Belt, and specifically if we drill down into some heavily Latino communities, we see some of the highest ratios of alternative financial service provision. Can you talk a little bit about how your work has connected to some of the findings that Matt has put forward? And I think some folks are gonna look at this and they're gonna say this is an expression of consumer preference, and I would love to know how NCLR and how you think about that, and how the communities that you work with think about that.
I think it's a great question, and I think just to build a little bit off of what Jacob was saying, I think the expression that we use is that it's really expensive to be poor. And I think that when you look at what is available in your community, if it's high fees and high costs of borrowing, high levels of minimum balance required for certain types of accounts, that gets really expensive when you're living paycheck to paycheck. So just wanted to put a finer point on that, because I think that's something that if you work in these communities, you kind of hear and know innately. And I think that these maps really help to show that on a broader scale. But I think in terms of the consumer preference question, there is an interesting problem that I think when people say, well, that's where people want to go. I think the challenge is actually back to the product question that I know will be explored later, which is that mainstream financial institutions are maybe not providing all of the types of products and services that individuals need in that community. So if you're in a high immigrant community, then you most likely need to be doing things like providing remittance services, or being able to open accounts using alternative forms of identification, maybe even consider lending using alternative data points of credit worthiness, like ability to pay utility bills as opposed to a credit score. And many mainstream financial institutions are not willing to do that, or had previously provided those services. Many of the large banks actually used to provide remittance transfer services and got out of that business. And so you, as an individual are creating a complex web of different places that you have to go in order to meet your needs. So we know from the FDIC on an underbanked survey that account ownership is actually quite high, really across all racial and ethnic groups, in the 85% range of people who actually own accounts. But you also cannot do all of the things that you might need to take care of in that one place. And so I don't necessarily think it's a matter of I prefer to go to this high-cost alternative financial service provider, but rather I need certain types of services and they're not all being offered in one place. And I just wanted to really in terms of the map, I just wanted to mention that I think that this is just going to be a tremendously powerful tool, for us in our advocacy work, that to speak with financial institutions and let them know about where some of these banking deserts are. We have affiliate organizations. The National Council of La Raza is the largest Latino civil rights and advocacy organization in the U.S. We have a policy team that focuses on federal policy, but we also have about 300 community-based organizations around the country providing services in Latino communities. And, they've had to adjust, just like I'm sure many of you do who directly serve the community here, that, creating their own mobile banking, essentially RV, to go to banking deserts to help people figure out how to conduct their financial transactions, teach people how to use mobile banking. And that's, for a nonprofit organization, is a pretty heavy lift. So certainly, location matters in that sense.
Andrea, you've worked in California trying to get banks to invest appropriately in sort of communities across the state. Can you tell us a little bit about that work, and tell us, I'm really interested, in your take on sort of this sort of product and service question, right? The location matters, but also sort of what's there for people. Is there a good case for us to be, is there a case that pops up in the data in your experience for us to be changing course in terms of what we see on the map? Do we need to make a difference in a different community? Should we be trying to get banks to open up in some of these deserts, or are folks kind of getting through and it's going to be okay?
It's not okay. It's not okay, and I guess I can speak to two different but overlapping populations that can illustrate the need. So one population that I do a lot of work with are cash aid recipients. So the vast majority of whom in California get their state aid on a state-issued EBT card. And place matters tremendously because we have maps like this where the places where they can go to use their card, the ATM that they can go, where they won't have to pay a fee, you can go literally miles and not get to a place where you can get make a withdrawal for free. And so in California, folks who use their cards, at an ATM, and the bank or the credit union or the owner of the ATM hasn't taken the affirmative step to waive that as a service that banks get CRA credit for. If they're not able to find those locations, they pay those fees, and those fees add up to over $20 million a year. It's $20 million coming out of welfare checks. So it's a huge problem. It's over 1% of what they actually receive in aid. So that illustrates, how, place matters. And we've done surveys where people will say, especially in the rural areas, that they will save up their transactions until they can drive into the next town over. It really affects not just the amount of money that they have available to them for things like eating and buying their kids' shoes. It matters in terms of how they manage their money, how much money they have access to throughout the month. Because if they can only go once or twice to the free location, or they go to a non-free location, they pull out as much money as they can, right? So that obviously affects how much they have over the course of the month. Another population are folks who are primarily cash-based. So you see that a lot in rural California, farm workers, but not just. So there's a lot of folks, the economy is really, it's really choppy in California if you're really low income. So you can be in a really cash, in cash industries, or you can be in like the gig, right? And they're both, low income. In the cash economy, there's, the ability to, in places where there's not a bank, and the banks are increasingly telling us, go mobile, technology is the way, that's the 21st century. You're asking folks to stay in the 18th century. We got to teach them how to use the apps and all that kind of stuff. And, my question is like, how do you do that with cash? You can't do that with cash. And for the folks who are trying to do that. There are some banks that are doing some innovations. So for example, Citibank, you can open an account online. You don't have to go to a branch. You can open an account online and without a deposit, and you tell them, I'm going to mail a money order. So you don't even have to have, the biggest problem with account opening through technology is that if it's online, you usually have to make a deposit right then and there, and it has to be electronically transferred from another account. So if you're unbanked, that option doesn't work for you. So the fact that Citibank, you can say, I'm gonna mail you a money order, is perfect. Because then it just solves the banking the unbanked. And I can go on about, Lindsay hit on, ID. This Citibank account works great. It has this great feature, but they only accept driver's licenses and state IDs. So if you don't have one of those, if your ID is a matricula or a municipal ID, then you're SOL. Like that, it doesn't work for you. So there is a really strong relationship between the product features, whether an account is safe, whether people feel the account is safe, and thankfully now we have, because of the advocacy that a lot of people have done, and including the National Bank On movement, there are now major banks who are offering accounts that are overdraft free, that people will feel, I'm safe there. I'm not at risk of this volatility of overdraft. So you've got that, but then you've got an inability to open that account if you can't get there, and then to be able to manage, over time. So there is a strong relationship, but if the bottom line question is, does place matter, for the folks that we advocate on behalf of, it absolutely does, because if they can't get there and they can't use the online app, it might as well not exist.
I'm so glad you touched on that tech question, because I think that's sort of it's in the poll question, and I think folks in the room have this. But Jeremy, can we go down the row, and starting with Jeremy Hegle from the Kansas City Fed, can we go down the row and talk about sort of where we are and what we think is changing sort of in this landscape, and are we if you live in the environment that I live in, you read a lot of, there's a lot of talk about societies going cashless, about moves to full-on tech. I think that's very different from the experience that Andrea just pointed out. But where are we on this curve, and what's coming, and what are some of the opportunities and challenges?
Yeah, great question. So one of our researchers at the Federal Reserve has done some work on the declining use of cash and checks, and we know that that's going down. What we found, though, is that it's not, cash is kind of leveled out. In checks, there's still a lot of resistance to adoption of other forms of payment when it comes to the small business arena. And so, and this also provides an opportunity and a challenge and a need for banks. So there's an interesting study that was done, and there's a bank, I think it's called Eastman Bank. They looked at all of their small business accounts and found that 5% of their small businesses were using online alternative loan products. And they talked to them. Long story short, there's a good example, of another study of a guy who is paying $100 to cash a $5,000 check at a cash processing place. He's a small business owner. He had gotten a job, he got the deposit on it, but he needed to cash that check, and he needed it that day so that he can start getting the materials and paying his day laborers and everything else. And through a traditional bank, waiting for that deposit to clear, he wouldn't have been able to have the job. And so there are some situations where banks are adapting and going with this example of Eastman Bank. They invested heavily into an online system that allows them their small business clients to apply for a loan and get up to a $100,000 small business loan with a 24-hour turnaround, and they're approving up to 70% of these requests, and they're now licensing that technology out. And so I think it's important, if I could back up for just a second, it seems like there's two things we've all been talking about, right? Like place matters, you have to have access there, but but we also know that if the product mix doesn't align, the small business owners or the general public is going to walk by. There is a study that came out, Lisa Servan, she's a University of Pennsylvania professor, and she actually went and worked at a check cashing place for 4 months to find out, what is really going on. And she says, you walk in and it's like walking into a fast food restaurant. I mean, there's just a menu. It's like, okay, I want a Big Mac, a money order, and I need to pay 3 bills. Okay, it's $8.95. Whatever it is, it's that clear, cut and dry. And so there's a transparency issue, and there's also a matter of figuring out how we can adapt to provide the services that are needed in an expeditious manner electronically, also recognizing that there are still some things that people want to do face-to-face. Not everyone's like this, but if I'm buying a mortgage, I want to sit down and talk to somebody about that, right? So I think there's a mix there.
Part of what you bring up there is, there's real deep questions of trust, right? I mean, money is, and I think, you'll see this a lot, folks are very reticent. Are there folks in the room that do financial coaching or counseling? Yeah. Are people reticent to talk about money, or are they leaping down your throat? Let me see hands on, it's tough to get people to open up honestly about money. It seems like and then the other side of the coin is folks are really way too willing to talk about how they spend and don't save their money. That seems like, for the most part, this is a thing that people are reticent to engage about. And I think that really goes to sort of a core question of trust. And that we see that sort of in some of the banking relationships and alternative financial service relationships. I also think that's going to be a key question sort of as the tech boom starts to pile up. Who has Venmo? Oh my gosh, it's amazing. Okay, great. So Venmo is a person-to-person on your phone money transfer app, right? So I'm going to overshare a little bit. I am in too many fantasy sports leagues, right? And it's with the guys of my brothers and the guys I grew up with, and we all live around the country. And, for like the last 10 years, there's a guy who's the treasurer, and he still lives in Vermont. And at the beginning of every season, everyone has to mail him a check for $25 because we're all super cheapskates. But that's the fee to get into the league, and whoever wins the league wins $250. And invariably, it takes 6 months to collect the $10, $25 checks from the laggards in the league. And then I'm in this other league with some other friends who are a little more urban and a little more tech savvy, and they all have Venmo, and it happens within like moments on your phone. It's just like bing, 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 gone. But if you pay attention, I think you'll notice in the media that there's a rising current of the safety and security of products like that are not the same as they are with a bank. And the recourses that you have if something bad happens to you are not the same when something bad happens to you. So can we talk a little bit about sort of, Jacob, I'd love to start with you on this, sort of that question of sort of trust and where it's earned and lost and where we're headed with that.
Sure. So I'm going to take a kind of roundabout approach to this trust question and talk a little bit about discrimination in that world. So I understand that there's this very strong temptation to look towards technological development as a kind of way to break this connection between place and economic destiny, to speak in broad terms. But I think there's a number of ways in which the advance of technology can exacerbate inequalities between individuals and places. For example, the more data that get collected about us and become kind of more publicly available about us, invite place to enter as a source of discrimination. So work that I've done with colleagues at NYU, we have shown that if online transactions indicate that you live in a poor black neighborhood, you're 20% less likely to get a response from a transactor than if you identify living in a wealthy white neighborhood. And I think we're seeing similar patterns in kind of, I don't know if widespread is too strong a word, but reports and research of discrimination in on Airbnb and Uber and other kind of, I really hate this term, but sharing economy kind of apps. And so I think that the move towards full-on tech is going to happen, but only for a certain segment of the population. And I think connecting this back to this earlier discussion around preference is really important, because when we talk about these things, we assume that people have these almost fixed preferences without acknowledging that preference can be shaped by the things that we're exposed to, the constraints that we have, for example, ID requirements at banks, or where and how cash assistance is provided by the government. And I really appreciate Jerry Buckland's framing around this. You know, the poor often have to make these hard choices about their financial services. And these decisions are usually shaped by things that are completely out of their control. So where banks and alternative financial service providers choose to locate, the structure of fees and services and availability of services, all influence what they can do, let alone what they want to do. You know, during the recession in New York, the percentage of people who had a bank account increased during the Great Recession, and the percentage of people who used a check casher also increased during the Great Recession. So there are also these broader kind of macroeconomic changes that influence, you know, the pocketbooks primarily of the poor. And I think that these kind of influences, these bigger factors, kind of are largely, unfortunately, absent from discussion of individual preferences and how that interacts with potential technological solutions.
So I have, you know, just one, you know, kind of broad comment about this whole issue of technology and mobile, and that's with any kind of disruptive innovation. There is, and you know, Justin just alluded to it. There is theoretically, and this has been, you know, backed by a lot of research in a variety of different fields, what's called an S-curve of take-up or adoption, that, you know, we can push out these technologies, these technological innovations, but the take-up rate, the level and rates of adoption among the users of that technology grows over time, and it doesn't grow in a real predictable and even fashion. So we have, you know, some early adopters and a group of people who are quick to seize on mobile. So in the data bear this out a bit, that millennials, for instance, are early adopters of a lot of these technologies. And then we have at the other end of the S-curve of adoption of an innovation, maybe some years later, another term that Justin used are the laggards, who are the people that are reluctant for a variety of reasons to engage with any new technology, in this case, you know, mobile financial services. So the thing to pay attention to is what do we understand about who those groups are, and what are their barriers to adopting new technologies? And those barriers can be things that are in their control, and it comes down to preferences, or it could be things that are just completely out of their control. So one of the things from our maps that you'll see is some really pretty significant rural-urban differences. And if you look at mobile, one of the things that's just out of the control of rural residents is the lack of cellular technology and broadband access. And, you know, which is kind of weird, you know, when for those of us that are used to living in more urban areas, we kind of take that for granted, that there's this infrastructure in plumbing that's just available to do whatever technology might enable us to do. That's simply not true in a lot of rural areas.
Yeah, I mean, that's a great point, and I think in particular as we think about what are policy solutions, right, for some of these challenges. There's actually a hearing next week on broadband access in the Senate, so that's, I think, a great place to look in terms of where there could be real policy efforts that need to happen to make sure that there is more access and availability for that. But I think, tying it back to the issue of trust and place, so we recently had a conversation with Bank of America, and they're starting this new community financial center experiment where they're looking at their branches that are in LMI neighborhoods and figuring out ways that they can make them more welcoming banking centers for people. So maybe thinking about redoing some of the interior just to make the space more inviting, but also thinking about how do they bring people like the tellers out from behind the glass, so to speak, and those scary looking things that nobody wants to go up to and talk to anyone. And actually talking to people in the line and trying to help them solve problems, increasing the number of ATMs at branches that, so for example, why does a branch that's in a high income area have 6 ATMs when everyone is direct depositing and, transacting online and mobile, versus a low income neighborhood where people on payday need to come and either cash their checks or deposit cash, and there are 2 ATMs at that branch. So I think that there are some simple solutions like that in terms of even just stepping outside of online and mobile, ways that technology can be leveraged to really make a space better for who lives in that place. And I think the other thing that I'd heard them talk about was as people are coming out and talking to customers as they're waiting in line, talking to them about how they could get enrolled in an account, like one of the no overdraft accounts, so that they can get access to all of their money right away instead of coming in and just cashing the check there and then not having access to the full amount. And then they're able to do that right away, using an iPad, enroll someone in an account. But it still begs the question that you'd have to go into a branch to get that type of service. And so where the branches are really matters if you're going to be able to take advantage of some of those innovations. And then I think on the credit union and community bank side, that these small institutions don't necessarily have the ability to create or to use the same types of technology as the larger financial institutions. So the services and the products they offer might be a better match for the community, but they're not able to do the online applications and the online account opening, or they're not able to do the mobile check capture. So there are limitations in terms of what the smaller financial institutions are able to do, even though they might be providing better services for a particular low-income population. So that's a little bit, I think, more on the financial institution side. Since I know Andrea's coming after me, she can talk on consumer side. But those are some of the things that we think about as far as what some of the barriers might be.
So you actually all touched on a lot of things I was going to say, so I'll speak to one issue that hasn't come up. And when we talk about trust, I think, I want to point back to some of the language in some of the studies that the assumption is that we're talking about safe and affordable, accounts and safe and affordable products, and that phrase sort of comes together, safe and affordable. It rolls off the tongue, but they are 2 different things, but they are very related, right? So part of safety is affordability, right? So if you're going to have a product, an account that's going to overdraft, and it's going to that overdraft fee is going to snowball, and at the end of the day, you're going to have $140 in fees, plus whatever the amount that you overdrafted. So at the end of the day, you could well owe your bank $300, bucks, and then so if you don't, that's not safe, right? You don't feel safe. So someone is not going to, and I can speak to this from experience. I grew up really poor, and for a long time I did not have enough money to cover my expenses, and I felt myself to be very bad at money. And that's the other thing that comes up for people, is that when you were saying earlier, people are hesitant to talk about money, and that's because there's a lot of shame. There's a lot of shame internalized about being poor and not being good at money management. And so people will take on this sense of responsibility that is undue because they're not seeing how, I've sat across from people who will say, well, I'm losing so much money in these overdraft fees, and I need to change that, and I need to get better about how I spend money, and I need to get better how about I manage money and things like that. But when you look structurally at how much they make and the cycle that they're in, they're set up. It's a system that has been created to put them there. And I've had to say to people, like, yeah, I understand and I really commend you for wanting to take responsibility for this, but a lot of really smart, really well-paid people designed this. So if you think it's gonna be you against them, that's not a fair battle. So there is a relationship between safety and affordability, because if you don't feel safe, if you were like me and you asked your employer not to direct deposit your check because $300 was going to be gone, and you asked for it, that's not feeling safe. That's about, feeling like you have to hide from your bank. So there is a relationship. And there's also just a relationship with having enough money to begin with, right? So I feel like sometimes when we have this conversation, and I have to remind myself and my colleagues about this too, and we actually remind each other about this because we all do it, I do it. We fall into this idea that if we could only solve these problems, then we could solve people's financial lives, right? And that's just not true. People are just not making enough money. I mean, it's just bottom line, people are not making enough money. And the source of their income and how they get paid all affect whether they can get direct deposit, whether they get a check that they have to cash, and if they have a balance, they don't want to deposit that check. If they get paid in cash, all of those things matter. So when we do advocacy, we really do push the institutions, the regulated institutions, because we feel like those are there are the most consumer protections in place, that we talk about safety and affordability of those products, which means in the space of folks who receive cash aid, we are actually promoting direct deposit of that cash aid, because that means that money is available on the first. In California, people with cash aid stagger. I don't know if other states do a staggering system, but there's just so many people that they can't process it all in one day. So there are many people who get it later in the month than other people. When you get direct deposit, you get it on the first. You get the whole amount. It's immediately available to you. You don't have to pay any fees for it. And you gain a whole lot more privacy, because your cash aid is now out of the EBT system, which means they're not tracking where you're going and how you're spending your money. So you gain all of this agency, all of this privacy, all of this safety, if the account doesn't have overdraft, if the account is structured in a way that your money is safe and you can feel safe in how you're going to manage it. So it's both. Safety and affordability are related, but they are different.
Thank you. I want to give a warning to the audience that we're going to come to you in a minute, so please have your questions ready. Some of Terry and Matt's amazing team is going to have microphones, so in a minute we're going to sort of want to engage you really in this conversation. I want to ask the panel one more thing, spurred really by what this brought up. I mean, Matt and Jacob, I'm really glad you guys brought up structure. I think structure does not get enough attention, right? That there are sort of, there are boundaries that none of us can really escape, right? And some of us have more ability to do that because of the resources that we have available to us. But I mean, Andrea, you just made, to me, a case that makes me wonder if, when we look at the map that Matt has shown, we see banks and credit unions and alternative financial services. For the most part, though they're regulated, and there's credit unions that are sort of a beast of a different stripe a little bit, but these are mostly private institutions. They're mostly working for profit. There's been a push the last few years for folks in our space to examine whether the public role in solving some of the challenges that people face ought not to be bigger. And there's actually been some really interesting and innovative governmental steps to create access to different products for people. The federal government now offers a free retirement savings product to anyone that wants to take it up. It's called MyRA, and I don't think that many people are taking it up because I think it's basically just a product that's sitting there and it's outside of a structure that connects people sort of automatically and seamlessly. But it's a really sort of innovative and interesting idea that the government would be the one that would provide this service. If we look back historically, in the US, it is not outside of the bounds of our history to have the government being the one that provides basic transactional and savings services to people. The largest bank in the world is the Bank of Japan, which is administered as basically a postal banking system. There's every one of these dots in Japan would be not everyone, but many of the dots on this map would be a public savings institution. Are we at a point where folks think to solve some of this last mile problem, to solve some of the sort of trust problems, and to solve some of the sort of baseline, if you need a place to go that you can sort of rely on to get started that is not going to be gouging you, do we need to be considering that as we go forward?
So you said if we go with this last mile. So if you have one more mile to go, do you build a whole new car? You don't, right? You like get behind the car that you have that's broken down and you push like hell, right? So yeah, I think that there's something there possibly in the postal banking system and the role of government and creating infrastructures that can support existing systems to make them more useful and accessible and translatable to the folks that we're talking about, the folks that are most historically marginalized and who come from a history of don't trust people because it's just not going to work out for you. It's just not going to work out. So you gotta, you go in there with that. So yeah, there is a role for government, but we have a banking system. We have a credit union system. We have a really robust, well-functioning, for the most part, financial services system that is not meeting the needs of this one population, which is a very diverse population. I'm not gonna, it's not monolithic, but we've let them get away with far too much for far too long. And I think rather than investing our energy in creating whole new banking systems, we should stop treating them like prima donnas that they feel like they can, get away, ignore the retail side and really care about their commercial and their, all of that stuff, the money-making side, and push them to do that. Make them do their goddamn job.
I'm not sure what more I could add to that.
You can hand the mic to Matt if you want.
No, I mean, I think in general, that's the infrastructure is there. I completely agree. And there are, in general, we've also invested in the infrastructure already around regulating that industry and providing very, very robust, although there's more work to be done, consumer protections. And so trying to stand up something new, I worry about whether or not we can, we would be able to create the same level of safety and accountability for new structures if we were going to try to start, and build up something new. I think that there are many other things that we can be pushing on, things like compensation structures within the financial institutions. Why is it that when you're successful, you may get hired by a bank branch in your neighborhood, but when you're successful, the path for you to move up is to go to a higher performing bank in a higher income neighborhood. Let's not do that. Let's make sure that people feel like they can, be successful in that company by staying in their neighborhood and continuing to serve their community. I do think that there are some places where, in terms of when you think about asset building, that banks, for example, are not doing a good job of where, Justin, your suggestion might be the right way to go, which is, there are many people, Maya raised an example, some states are doing work around creating state-run retirement programs for individuals who work in an industry or for a company that doesn't provide a retirement account. Your company is too small, or it's, in terms of the industry, maybe it's a construction company and you don't have a real robust HR department, so you don't provide a retirement package or access to a plan. So having a state-run program for something like that makes a lot of sense, and those aren't the types of things that banks are doing well, and that I think we would make a lot of progress in terms of if we did push them to do their jobs. I'm not sure that we would really have the same type of plumbing there. So I think it's both and.
Let me be unfair and ask, no, Matt, I need you to talk about this. Let me ask, but Matt, Jacob, and Jeremy, if we could go quickly so that we can engage the audience.
Just very, very briefly, I think my hope is that there could possibly be some political consensus that what we're ultimately talking about with financial services with respect to low and moderate income households is that we have a certain degree, and we can argue about the degree to which this is true, market failure. And collectively, that was the realization with health insurance that led to passage of the Affordable Care Act.
I agree with all this. I don't know if we need the government to build a car for every last mile across the country, but there's no way that we get what we've been talking about without the heavy involvement of the federal government, and state and local governments as well. The invisible hand of the market is not going to and hasn't been serving these communities.
So in this country, I don't think we like government competing with private industry, for right or wrong. I don't think there would be a lot of interest or trust right now in the government doing something like that. I also think that when it comes to this topic, with many topics, there are a few silver bullets left in the world that just will fix everything. And I think it's a growing, living, breathing thing. And when it comes to the regulations, we need to constantly look, are the regulations in line with what's happening in this country right now? I also think while there have been some definite big bad examples of banks not being good community partners, I know walking in this room, I saw a lot of community groups I know in this community talking to the bankers that I know in this community. So let's not throw everybody under the bus, and let's recognize that there is a lot of good going on in the community.
We have folks running the microphone. I'm going to a certain extent, let them find you. But Nick, can we start right here in the middle? And Ashley and Nick can line folks up in the order. Just give them a wave, and they'll bring the mic to you. If you could, let us know who you are so that we can be a part of a community together. And if your sentence ends in a question mark, you'll make everybody very happy. Thank you so much.
You can count on it ending in a question mark. My name is Bill Mullins. I'm a one-man band called the Kessler Institute, and my goal is to organize regional interdependence to get past fragmentation and parochialism and apathy. So I come to a lot of events like this, and I'm pretty familiar with the local scene. For example, the fact that in Kansas City is ground zero for the online payday ripoff industry, better than Wells Fargo when it comes to trust. My question really is, in addition to the issue of market failure, I want to challenge my academic friends to say we have an analytical failure, and that includes our friends at the Fed and some folks in this building, as a matter of fact. Most of the perspective here, with the exception of the get them to do their goddamn job comment, it still ends up talking about products. And ultimately, that's a supplier perspective. And most of us work in the demand side. And it's an intersectional demand, it's householding, it isn't just one feature. We have a recent report that identifies 9 different layers, and one of the maps we saw earlier of Kansas City shows that housing and traffic and graduation rates and a whole bunch of other things are all intersectional in terms of talking about this. So my question and my challenge to the academics here is, who are you listening to when you sit down to think about drawing these maps? Because I believe there are more highly intersectional compounding ways, and given the tableaus of the world, better maps to be drawn. I don't feel like the people who have inputs to that are yet being consulted. Is that true? And if so, what can we do about it?
That's a great question. I mean, folks only live one financial life, right? You live one life, and how you access your housing impacts everything else in your life. Jacob, do you want to start?
I just briefly want to say I agree completely. I think that the reason that I focus on space in my research is for precisely this reason, is that where you live impacts every aspect of your life, from the environment in which you're breathing the air to the schools and the jobs that are available to you, and that capturing those relationships in a picture is very difficult. And I think that I'll let Matt answer for himself, but I don't think he's trying to simplify the nature of space and segregation to this one variable. Oh, sorry, and to answer your question, Mark, I think that the way to address this issue is better relationships with people in the community, between academics and people in the community.
Yeah, it's a good question. I think that the question about is it analytical failure depends on the nature of what we're trying to accomplish, and I think your point, like Jacob said, is certainly fundamentally true, that there's a complexity to the lives of low-income households and communities that's certainly not captured on these maps, nor is it our goal to try to do so. And mapping is just one tool to try to answer some questions. There's a whole lot of fantastic qualitative research, like Jacob referred to with Lisa Servan and her ethnographic research around check cashing. So, academics are limited by the data we have available to us, and to the extent that that's true, we're challenged to consider a range of different methods and to do just as what you suggested, to talk directly to people that are using and interacting with financial services, which is exactly what Lisa Servan did. And if you haven't looked at her work, I really encourage you to do so.
Just let me add one thing on that point, because I think it resonates a lot with my community, which policymakers and folks who are trying to influence the policy process in Washington, D.C. don't have a great track record of listening to folks in the community. And I think one of the things that we're trying to do in our work is to find a way to marry evidence with community experience going forward. And I'm optimistic that we can figure out ways to have greater participation of ordinary citizens in the policy design process, and do so in a way that removes bias and stereotype from policymaking, because we see a lot of that happen these days. One bad story leads to a host of bad laws and leads to a lot of bad products and bad outcomes for people. So thank you very much. That's a great question. Andrea?
Yeah, I just want to make one last comment around this. So I take a lot of issue with Lisa Servan's work. I understand that there is some limited value to what she's done, but her ultimate conclusion that these are really good products, or they should be fine, or they're working better for people is just patently untrue, number one. And number two, she's a white middle-class woman going into communities where she's not from those communities, and there are so many of us, people of color who grew up poor, who are poor, who have been telling the same stories and just didn't get published. And many of us are in this room, right? So the people in the community groups, the activists, the community activists, the folks who don't get paid for this work, those of us who do get paid to do this work, who are fortunate enough to get paid to be activists and advocates for our own communities, we have a lot to say, and the Fed and the FDIC and the OCC have community contacts policies, and when they do CRA exams, they are supposed to call community folks, community leaders, and listen to them to develop their performance context analysis against which they will judge the bank. Is the bank meeting the community needs? So that process needs to be made so much more robust, because everybody in this room who has a story to tell is just as important as someone as Lisa Servon who can get published because of the resources that she has. Everybody here has a story to tell, a community to represent, and those voices need to be listened to way more than they are now.
We'll go back to the audience.
What role do you see credit unions doing to increase financial inclusion?
That's a great question. Can you let us know who you are?
I'm Jenna Groth. I'm with ECAN and AmeriCorps.
Great, thanks so much. Matt, sorry. Jeremy, would you start?
Well, I was going to say, when it comes to credit unions, we have different types of financial institutions, right? We have, I know a credit union here today that's also a CDFI, and the regulations and requirements of different sized banks are different than the regulations and requirements of a CDFI versus a credit union who might also be a CDFI. Long story short, what that means is they have more flexibility in what they can do. And so Holy Rosary Credit Union is someone that was here today, and they're actually embedded in a community organization. And so they're able to go beyond, I think this is part of a question earlier, and this is something that the banks could do as well, is potentially go beyond the idea of product and combine that with the services. And so integrated service delivery, is there financial education that's needed? Is there assistance with getting emergency assistance? Is there other organizations that can help them? That type of wraparound service for the most vulnerable is something where there's a lot of room to grow and a lot of room to have conversation. And if I could spin back to the last comment, when it comes to Lisa Servon's work, I don't disagree with you on that. I look at that as, when I saw that, I thought, what are some lessons here that banks could learn from in terms of being better at providing the services that are needed? So, does it look kind of tacky to have like the fast food menu board at the top when you walk in? Sure. Is it clear, cut, and dry, and do the consumers know? So I don't see that as dismiss the need to provide financial services to that population. I see it as, what can banks and credit unions do to learn how to provide better service to that population?
And again, that's an act of listening that really is required there. Matt, we talked a little bit yesterday about some of the research you guys have done, and the credit unions do show up a little bit differently. Do you want to give us a really quick word on what the data suggests? I know it's not perfectly clean, but we do see some differences between credit unions and banks.
Yeah, that's the differences that we saw between banks and credit unions were from the product level research we did. And on that point, I'm going to not say anything further because you're going to hear about that later.
We've identified a couple more folks in the audience. Ashley, can we go here first and then Nick over there? Thank you for waiting.
Hello, my name's Mike Kuban. I'm with an agency called Ability KC. And the ending with a question, or even starting with a question, I guess what I keep thinking is there's almost a different question for every person who's in here, depending on who your constituency is and who you're representing and where you're coming from this at. And I guess for me, my biggest concern is that alternative financial services and the proliferation of them. But the reason, I guess, maybe is the why. Why are there so many of them? I mean, if there wasn't a demand or meeting a need, even if they built them, people wouldn't go. So the fact that so many people are turning to these services, I think, is the big question as to the why. And I think there's a different why depending on which group you represent. Whether it's a mistrust of the banks, if it's the bank isn't there, the bank won't serve me. There's just so many factors and there's so many problems. I think it's a big disservice to try to sit down and say, well, if we do this or this or this, we're going to fix the problem. I think it's too complicated than that. But I just think of the people that I represent, and I think, one of the biggest things is they're in survival mode. And when you're in survival mode, you're nearsighted. And when you're nearsighted, you need to survive right now today. And I can walk into a place, and yes, the interest rate on that is way more than the overdraft fee than a bank's ever going to hit me for. But they're solving my need right now, right here, and I don't care what happens 3 weeks from now. All I care is what happens tonight. And I think that's part of the problem. And just to add to that last mile thing, I guess for me, what popped into my head is that whole debate over the car or not car and everything makes sense when that last mile is still a road. But when that last mile is a chasm, then it doesn't matter anything about the car. And and I think for a lot of families, that last mile is a drop-off. It's a bottomless pit, and they hit that, and they don't see any answers that make sense.
We'll let you slide without a question mark. Thank you very much. I think you addressed that a little bit earlier. I don't think folks that exist in this space and I don't think any of us in our professional lives, and it's tough on a panel, right? Because you only have so much time, and you try and bring a focus beforehand. But this issue of sort of like, hey, listen, folks are hurting and they don't have that much money, underpins everything. So I want to recognize that. And I also want to mention, I saw a fascinating, and the research is valuable because it suggests to us what we can do in the world. And you're right, it's very complicated and nothing is sort of straight line. But I saw a piece of research earlier this week that I need to investigate further. It came out of the Washington Center for Equitable Growth, and the top line finding was a $1 increase in the minimum wage in a state reduces the use of alternative financial services for the impacted population by something like 45%. So you start to see stuff like that, and you start to think about, if we can deliver more resources to people, we start to solve a lot of these other problems. There's no two ways about that. I want to go right over here for what I think is our last question of this session. Thanks everybody for your participation.
Thank you for everything you're talking about. My name is Edgar Galicia, and I'm with Central Avenue Betterment Association, a community organization here in the Kansas City, Kansas area. So, as I understand this map, and I think we can all share this, it represents many variables, such as health per se, just per one. But so let me solve this of reaching out into the markets, because all of the discussion is market-driven, service-driven, as if banks were everything or financial institutions were everything, and we have forgotten about bottom line savings, the learning about saving ourselves and building equity. So why don't we do a non-for-profit cash system or cashing system where anybody can go within walking distance and cash their checks? These banks, who are making enormous profits, can provide that as a service. So I'm going to leave it there, but where or who is driving the relearning how to save in our communities, relearning how to manage our monies in our communities, relearning how to build our equity in ourselves, in our communities, in our household? Who is teaching us again how to buy cash and have own paid for all of it, instead of bleeding with all of these paying to the big companies on credit and on interest and all of these? Who is driving that? How are we relearning how to save?
Matt, do you want to, I think that's actually a terrific segue to the rest of the day. One of the things we haven't touched on is that one of the other functions of the map is that it identifies nonprofit providers that are providing some of the kinds of services that you're talking about, again, all across the country. Individual development account programs that match people's savings and help them to save to buy a home or own a small business. And financial empowerment centers where mayors and city councils are creating financial coaching and education programs that are free to their citizens to come and use those services so that they can help to try and make personal changes to improve the way that they're able to manage their money. Those things are really valuable and really important. I think one of my key takeaways is we have to figure out some ways to get at the structural issues as well, because if we don't change the sort of underlying structure, we're going to have a lot of challenges going forward. Thank you all for giving us your feedback and for your honest opinions. And thank you to this really smart, really terrific panel. Jacob, last word? Yeah.
Aman, I really appreciated that last comment and all the questions and comments. I wanted to just make a point that I am somewhat hesitant to point to financial literacy, broadly speaking, as a kind of silver bullet to these problems for a number of reasons. The first is, and I agree 110% with the criticism of Lisa Servan's work, the one nugget that of her findings that I do like is that the people who use these services often know that they're paying more, but they're actively choosing to do so. They're compelled to do so by the structure of the fees and services of the mainstream availability around them. Two, people at all points of the income distribution make seemingly bad decisions with their money, but we kind of shame the poor and punish the poor more for making the same kind of bad decisions. And third, I think most importantly, what's implicit in a sole focus on financial literacy, and this is not to say that education is unimportant, but a sole focus on financial literacy as a solution, we're implying that we're okay with an economic system in which people can be exploited because of their lower education. And I think instead we should be working for a more inclusive social and economic structure, such as a nonprofit banking system.
I think we should give them a round of applause and thank them for their discussion. And you for your questions. One of the nice opportunities about being here together today, I think, is for the opportunity for people who are practicing, who are working day to day, for people who are academics doing research, for people who are advocating for policies, so that we can talk to each other. As it's the person who gets to ask the research question has a lot of power in what the information then becomes down the road. So to be able to make sure that the right questions are being asked, we want to hear what those are, especially as we mingle throughout the day and as you ask questions during Q&A, so that we're all on track together from our respective vantage points. So we are going to take a break until 10:45 and come back for the second panel. So thank you. Enjoy some coffee. I think that there are snacks and refreshments out in the hallway. So thanks.